How do investors decide how much a startup is worth? Is it just a guess, or is there a formula? Welcome to Startup Valuation 101, where we break down how startups are valued and how investors calculate millions or even billions of dollars in funding rounds. Let's dive in. Segment 1. What is startup valuation? Startup valuation is the process of determining how much a startup is worth. Unlike established companies with revenue and profits, startups are valued based on their potential for future growth, their team and technology market size and competition. Basically, investors are betting on how big the company can become. Segment 2. Key factors that affect startup valuation. Before an investor writes a check, they consider these key factors. 1. Traction and growth metrics. How many users or customers does the startup have? Monthly revenue, growth rate, and retention matter. 2. Market size. Is this a billion-dollar industry or just a niche market? The bigger the potential, the higher the valuation. 3. Team and founders. Investors look at experience, execution skills, and leadership. A strong team can raise valuations even if revenue is low. 4. Competitive landscape. How many competitors exist? Does the startup have a unique advantage? 5. Revenue and business model. Startups making millions in revenue get higher valuations. Subscription-based models often get better valuations. Segment 3. How startups are valued in different funding rounds. Startup valuation depends on the stage of funding. Seed stage, 1 million, 5 million. Early stage, high risk. Series A, 10 million, 30 million, startups with traction and revenue. Series B and C, 50 million, 500 million. Scaling fast, strong user base. IPO and beyond, billions. Publicly traded companies. Segment 4. Common startup valuation methods. Now let's talk valuation methods. Investors use different approaches to decide a startup's worth. 1. Market multiples, revenue-based, multiply current revenue by an industry standard number. Example, if startups in the industry are valued at 10x revenue, a startup making $5 million per year could be valued at $50 million. 2. Discounted cash flow, DCF. Investors estimate future earnings and calculate today's value, used for startups with strong, predictable revenue. 3. The Berkus method, used for early-stage startups, assigns value based on the idea, team, market potential, and product. 4. Venture capital, VC, method. Investors predict future exit value, like an IPO, and work backwards to calculate how much they should invest today. Every investor has their own approach, but it's all about future potential. Segment 5. Unicorn valuations. Are startups overvalued? Ever heard of unicorn startups? These are startups valued at over $1 billion, but not all of them are successful. WeWork was once valued at 47B, before collapsing. Theranos was worth 9B, until it turned out to be a fraud. Uber and Airbnb hit massive valuations, but profitability took years. Lesson: high valuation doesn't always mean success. What do you think about startup valuations? Are they too high, or do investors know what they're doing? Let's discuss in the comments. And if you found this video helpful, don't forget to like, subscribe, and hit the bell for more startup and finance insights. See you in the next video.